Imagine you had invested $100,000 in the stock market 3 years ago. Today, with the right choices, that money could have grown significantly, perhaps even doubled. But with so many options out there, how do you choose the best investment to maximize your returns? Consider the tech giants like Nvidia and Apple, part of the Magnificent Seven that have skyrocketed in value. Investing in individual stocks, though, can be risky and time-consuming. This is where dividend ETFs come into play. Today, we're diving into two popular dividend ETFs, SCHD and JEPI. Both have unique strategies and benefits, but which one is right for you? More importantly, how can a $100,000 investment in either ETF impact your financial future? Imagine the peace of mind knowing your money is growing steadily and providing you with a reliable income stream. By the end of this video, you'll have a clearer understanding of where to place your hard-earned money for maximum growth and income. Stay tuned as we compare these two ETFs in detail, exploring their strategies, performance, and long-term potential. This ultimate ETF showdown will arm you with the knowledge you need to make an informed decision and take control of your financial destiny. Let's get started. If you want more tips on building wealth, hit the subscribe button. Your support helps us create more valuable content for you. Last year, the stock market was electrified by a select group of powerhouses we like to call the Magnificent Seven. These tech titans, Nvidia, Apple, Microsoft, Tesla, Alphabet, Amazon, and Meta, delivered performances that left investors in awe. Leading the charge was Nvidia, whose value skyrocketed by nearly 250%. This phenomenal surge was fueled by groundbreaking advancements in artificial intelligence and gaming technology, solidifying its place as a market favorite. Even the least impressive performer of the group, Apple, saw its value jump by more than 54%, underscoring the collective strength and dominance of these industry giants. Now, you might be thinking, should I just buy stocks like Microsoft, Tesla, Alphabet, Amazon, and Meta? It's a valid question, given their impressive returns. However, diving headfirst into individual stocks can be risky. Market downturns or company-specific challenges can swiftly erode your gains. This is where dividend ETFs come into play, offering a blend of growth potential and stability. Enter SCHD and JEPI, two dividend ETFs that provide a balanced, diversified approach to investing. By spreading your investment across a basket of stocks, ETFs help mitigate risk and offer a steady stream of income. In this video, we'll delve into why these dividend ETFs might be a smarter move for long-term investors seeking growth and income. Let's explore how SCHD and JEPI stack up against each other, and which one could be the better fit for your investment strategy. Why consider ETFs? Imagine a world where your money works tirelessly for you, growing steadily and providing a reliable stream of income. That's the promise of investing in ETFs, especially dividend ETFs like SCHD and JEPI. But why are these investment vehicles so compelling? Let's uncover the magic behind them. First, let's talk about diversification. It's like having a safety net for your investments. Instead of betting all your money on a few individual stocks, ETFs spread your investment across a multitude of companies. This means your risk is spread out too. If one company stumbles, your entire portfolio doesn't take a hit. Think of it as having a team of all-star players rather than relying on just one superstar. Next up is the allure of steady income. Dividend ETFs are like the gift that keeps on giving. Companies that pay dividends share a portion of their profits with you, the investor. This means regular income, whether the market is soaring or dipping. For those in retirement or anyone seeking extra cash flow, this can be a game changer. SCHD and JEPI are champions in this arena, focusing on companies with a strong track record of dividend payments. Cost matters, and ETFs shine here too. With lower expense ratios compared to mutual funds, more of your hard-earned returns stay in your pocket. SCHD and JEPI are known for their low fees, enhancing your potential gains over time. It's like getting VIP treatment without the high costs. Liquidity and flexibility are other standout features. ETFs trade on exchanges like stocks, allowing you to buy and sell throughout the trading day. This means you can respond swiftly to market movements, seizing opportunities as they arise. Whether you're a seasoned trader or a novice investor, this flexibility is invaluable. Stability is another key advantage, especially in volatile markets. Companies that consistently pay dividends are often financially robust and well-established. In market downturns, dividends can act as a cushion, providing income even when stock prices are falling. Investing in SCHD and JEPI can give you peace of mind, knowing your portfolio has a stable foundation. Lastly, transparency is a hallmark of ETFs. You always know what you're investing in because the holdings are typically disclosed daily. This transparency builds trust, allowing you to make informed investment decisions with confidence. In essence, ETFs, particularly dividend ETFs like SCHD and JEPI, offer a winning combination of diversification, steady income, cost efficiency, liquidity, stability, and transparency. These attributes make them an attractive option for anyone looking to build a robust and resilient investment portfolio. So, are you ready to unlock the full potential of your investments with SCHD and JEPI? Let's dive deeper into their specifics and see how they can transform your financial future. Comparing SCHD and JEPI. Which dividend powerhouse is right for you? In the world of dividend ETFs, SCHD and JEPI are the crown jewels, each offering a unique approach to generating income and building wealth. But which one should you choose? Let's dive into the battle of these dividend titans and see which one aligns with your financial goals. SCHD. The growth-oriented dividend. First up, SCHD, the Schwab U.S. Dividend Equity ETF. This isn't just any ordinary dividend ETF. It's a finely tuned machine designed to capture the best of the best in the dividend world. SCHD zeroes in on high-quality companies. Think industry giants with rock-solid financials and a track record of consistently growing their dividends. This isn't just about collecting dividends. It's about building a future-proof income stream that can grow with you. What makes SCHD stand out? It's the rigorous selection process. SCHD doesn't just pick companies that pay dividends. It targets those poised to keep growing them. You're investing in stability, yes, but also in potential. Companies in SCHD's portfolio are leaders in their fields, offering both the security of steady dividends and the excitement of growth potential. If you're looking to build wealth over time while enjoying regular income, SCHD might just be your perfect match. JEPI, the income-generating juggernaut. On the flip side, we have JEPI, the JPMorgan Equity Premium Income ETF. JEPI takes a different route, one that's laser-focused on maximizing income right now. How? By blending high-quality, low-volatility stocks with a smart options strategy. This combination allows JEPI to crank out a higher yield, making it a go-to for those who want steady income, especially in today's unpredictable market. JEPI's secret sauce lies in its ability to generate income beyond traditional dividends. By selling options on its stock holdings, JEPI pulls in extra cash, which it then pays out as juicy dividends to its investors. The result? A higher yield than you'll find with many other ETFs, including SCHD. But there's a trade-off. JEPI might not offer the same level of long-term growth. It's more about income today rather than tomorrow. JEPI's portfolio is built for stability. It leans into companies that can weather economic storms without sacrificing their dividend payments. If you're someone who values consistent income and wants to minimize risk, especially when markets are rocky, JEPI might be calling your name. Which one fits your strategy? So, how do you choose between these two heavyweights? If you're in the market for a mix of reliable income and the potential for future growth, SCHD's focus on quality and dividend growth could be your winning ticket. But if you're more interested in maximizing your income right now and prefer a defensive strategy, JEPI's approach might be the better fit. Here's the kicker. You don't have to choose just one. Some investors find that combining SCHD and JEPI in their portfolio gives them the best of both worlds. Growth potential from SCHD and high income from JEPI. Whichever path you choose, these ETFs are powerful tools to help you build a resilient and rewarding dividend portfolio that suits your unique goals. Investment strategies. Let's dive into the brains behind SCHD and JEPI, two ETFs that are gaining a lot of attention, and for good reason. Think of SCHD, the Schwab U.S. Dividend Equity ETF, as the reliable, steady performer in your investment portfolio. It zeroes in on top-tier U.S. companies with a proven track record of paying dividends. These aren't just any companies. They're the ones with rock-solid balance sheets, consistent earnings, and a history of increasing their dividends over time. SCHD is all about building wealth the old-fashioned way: slow, steady, and reliable growth through quality companies that know how to take care of their shareholders. Now, let's talk about JEPI, the JPMorgan Equity Premium Income ETF. If SCHD is the steady performer, JEPI is the income generator that knows how to play the market for profit. JEPI doesn't just invest in stocks. It adds an extra layer of income by writing covered calls on its holdings. This means you're not just earning dividends, you're also collecting option premiums, which can supercharge your income potential. JEPI's strategy is like having a smart, calculated risk taker in your corner, ensuring you get paid even when the market is playing hard to get. Risk factors. But with potential rewards come risks, and it's important to understand what you're getting into with each of these ETFs. SCHD's biggest risk? The stock market itself. No matter how strong the companies in its portfolio are, SCHD is still tied to the ups and downs of the market. If the market takes a hit, SCHD could too. And if the companies within SCHD face challenges, like declining profits or cutting dividends, that could directly impact your returns. It's a classic case of no risk, no reward. But with SCHD, the risks are tied to the overall health of the market and the specific companies it invests in. JEPI, on the other hand, has a different set of risks. By using an option strategy, JEPI caps its upside potential. This means if the market suddenly surges, JEPI won't capture all of those gains, because it's already locked in profits from the covered calls. And while this strategy is designed to reduce volatility and protect against losses, it's not foolproof. JEPI's income can fluctuate depending on market conditions, and if the market turns sour, even this conservative income strategy could face challenges. Performance analysis. Let's talk performance, because at the end of the day, that's what matters most. SCHD has been a reliable performer, offering investors a steady mix of dividend income and capital growth. It's like a well-oiled machine, chugging along, building wealth over time. Even when markets wobble, SCHD's focus on quality companies helps it stay on track, making it a solid choice for those looking for both growth and income. JEPI, on the other hand, has carved out a niche for itself as a high-income generator. With its covered call strategy, JEPI doesn't just rely on dividends, it pulls in additional income through premiums. This means JEPI can deliver impressive yields, even in tough markets. However, because JEPI's strategy limits its potential for big gains, its total returns might not match more aggressive growth ETFs like SCHD. But if your goal is to generate steady income while keeping volatility in check, JEPI could be exactly what you're looking for. Case study: $100,000 investment. Now let's imagine you've got $100,000 ready to invest. You decide to split it evenly between SCHD and JEPI, $50,000 in each, and you're planning to hold on for the next 5 years. For SCHD, this investment could steadily grow, thanks to its focus on dividend reinvestment and capital appreciation. With an average annual return of 8%, your $50,000 could turn into around $73,266, assuming you reinvest the dividends. It's the kind of growth that builds wealth over time, without taking on excessive risk. JEPI, on the other hand, is all about generating income. With its robust yield of around 8 to 9%, your $50,000 investment could generate between $4,000 and $4,500 in annual income. Over 5 years, that's $20,000 to $22,500 in cash flow, on top of any potential capital gains. This steady stream of income could provide you with the financial flexibility to reinvest, spend, or save as you see fit. By investing in both SCHD and JEPI, you're not just betting on one strategy. You're diversifying across two powerful approaches. SCHD offers the potential for growth, while JEPI delivers on income. Together, they form a balanced investment strategy that can help you navigate the ups and downs of the market while steadily building wealth. If you're intrigued by the potential of turning a smart investment into substantial gains, now is the time to act. Whether you lean towards the steady dividends of SCHD or the dynamic strategy of JEPI, the key is to start your journey today.